Hey everyone, welcome back to Yuri's Box. In this video, I'm going to quickly look at the price action of the S&P 500 for the day. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. I'll try to keep this video short. The word of the day was funky because it was really a funky day in my opinion. Just taking the perspective of you know, the typical correlations that we've seen, especially what happened overnight, and like in Japan, with the Nikkei falling 4%, which was not a great start to the week, in my opinion. But if you just woke up like that, you would imagine that the yen had strengthened quite a bit. Okay, you go and look at the yen, and although it had some strength to it. It wasn't anything too dramatic, and throughout the day it kind of reversed. And if you take the perspective of the yen actually weakening throughout the day, you'd think, well, then bonds didn't really perform that well. But on the contrary, bonds performed well. A 30-year yield is lower by about 5 basis points. At a certain point, we were definitely higher, even by 5 basis points. But from the open, that is. But again, we closed. We had a solid close on bonds. And again, if you put the risk off sentiment in bonds, then you think, well, then the S&P 500, to kind of go back to square one, didn't perform so well. But we ended up on the day, we ended up 0.5% up, and we actually bounced. You could actually make the case that we actually put in a fairly nice double bottom here, possibly. But again, it was kind of a funky day, really. Nothing, you know, of the usual suspects really worked today, in my opinion. It was really just a weird day. But I guess this is really to be expected given what we're looking at, and that is April 2nd. And I'll keep this here so you can have it in front of your eyes. This is really how I'm going about April 2nd, and it's to give you the rundown. What I'm really interested in April 2nd is to see whether tariffs are being treated as policy or a tool. And if you see something like, something more benign, that to me could be an indication. Or again, you could easily go, have the maximalist approach and keep those as, as policy. That would probably be one of the worst outcomes, as well as the just keeping the uncertainty alive. But in any case, to keep things simple, low tariffs could be cheered in the short term. Okay, so it could be more benign outcome in the short term, but it could lead to more pain in the future, because what you're doing is potentially making them structural. Okay, and so actually making us live in a world where we have tariffs, and tariffs are not a tool for something else. If you see, again, a harder approach to tariffs, so something a bit harsher get put in place, that could be the worst outcome in the short term, but potentially it could give you an indication that they are a tool in order to get trade deals get settled. And I think, and I've talked about this in my previous videos as well, I think the main objective here is the EU. Simply because if I take the perspective of the challenges that the US will have to face in the coming years, namely China, it would be easier to have the EU back under the economic sphere of the US. And I say that with, knowing full well that, I'm implying that that the EU isn't under the, economic influence of the US. And the reality is that, you know, the EU today has significant ties to, still to this day, to Russia, because we're still importing, as as a continent, a high percentage of energy that we consume. And without China's exporting to China, no, I mean that's the whole the economic model of Germany, really. So if I take that view, I could easily see the US trying to break some eggs and try to make an omelet, and the omelet being a new trade deal with the EU, possibly about energy and security, and possibly bringing down certain tariffs. But this is in the making. We still have to deal with April 2nd, in my opinion. And so really, the question you have to ask, that needs to be the answer that we're looking for on April 2nd is, what are we doing here? Are we treating tariffs as economic policy, and so are they here to stay, or are they a tool? And I think that's what's worth trying to figure out on April 2nd. As far as the S&P 500 is concerned, you could say this is a double bottom. You could say that things could have a rally, a significant rally over here. And again, I was expecting this rally to be a bit more aggressive. Potentially, as I said in my previous videos, go up to the 5,900 target on the index. We didn't get there. We stopped, just 120 points shy of that. Could that be the rally that the next, the upcoming rally that takes us back to 5,900? Could be. But this week is so huge, and a lot of things can change from, by dinner time, that, it's best practice is try to stay sane and try to protect capital. I think this is, I find myself in agreement with, the people that, that opinion, really. Try to preserve yourself. Don't really try to time things, because this isn't really a time to time things, no pun intended. But again, it's not about the technicals, as I've been saying ever since I started making videos, and talking about these funny times we live in. It's not about the technicals. It's not about the double bottoms and the bull flags and the bear flags. It's about economic data, most of all, and economic policy at this point, really. I've talked about many times about fiscal tightening. That's acting in the background. Now we have April 2nd. All right. We have to deal with April 2nd first. Let's see what happens on April 2nd. Let's see how tariffs are being thought of. Are they being thought as economic policy or as a tool? And that's a good starting point, in my opinion. So where do I see the S&P going next? I have absolutely no idea. It could be as a so-called clearing event. All right. So once we know where we're at, fine, let's deal with it. But at the same time, as I've said in previous videos as well, beware certainty. All right. Just because you know where you're at doesn't make it necessarily better than not knowing where you're at. Okay. Uncertainty is bad, granted. But having to live in a world where you have, just flat out 20% tariffs on everyone in the world, that is disruptive. Okay. So as much as everyone wants certainty, you know, just be careful. Be careful what you wish for. That is what I'm saying. But again, we'll wait and see what happens on April 2nd. And again, it was just a weird day overall, in my opinion. It could also be because I didn't really, you know, I wasn't in front of my laptop all day. I was still, out and about. But I kept a close eye anyhow as much as I could. And again, I just saw like the yen not moving, bonds rallying, and the S&P doing basically everything from dipping to rallying. Okay, so it was just a bit of everything. And on top of that, we also got credit spreads. That's a nice place to end the video. So the latest update for this, I mean, if I'm not mistaken, this is Friday 28th data point. So this is still lagging. I don't remember if they're really the live ticker. I have to find it. But in any case, as far as this video is concerned, it's good enough. We're still seeing credit spreads move up. We're still seeing credit spreads on the rise. And I think that is just adding fuel to the fire, okay? We're seeing stocks act erratically. We're seeing the risk off trade in bonds continue. All right. And at the same time, we have credit spreads possibly breaking out of the trend line of the trend line that was in place ever since 2022, really. Okay. I would pay attention to this on April 2nd a lot. Okay. So if you see credit spreads continue to widen, something's amiss. And but again, given the fact that I'm pointing it out, it's probably already already old news. But we'll see how things evolve. Credit spreads tell you a lot. If you're not familiar with credit spreads, and I'll close the video on that. What you're basically measuring here, you're measuring a high yield corporate bond, and I think the rating on these bonds that we're measuring is double B or triple B. It's late for me too. And what you're measuring them against is, a particular treasury, whatever, for equal maturity, at equal maturity, really. So if you're measuring a 10-year corporate bond, double B or triple B corporate bond with a 10-year maturity, and you're comparing it to the yield of a US 10-year treasury, all right? And what you see here, the 3.7%, is really the spread between what the 10-year on the treasury is yielding and the double B corporate bond. The larger the spread, that just means that investors are demanding a bigger premium in order to give money, to that corporation, to that low-rated corporation, all right? And so when credit spreads, again, are low, that means that investors are complacent, and they have a low perception. I mean, really, they perceive that bankruptcy risk is low. If you see credit spreads widen, like here we saw in 2015, or if you really want to go hardcore, we're gonna have to zoom out a bit. 2008. Whenever you see credit spreads really on the rise, that is an indication that something's not right. Right, to keep things simple. So keep an eye on on the credit spreads side, because of everything that it entails. So really, quite a messy day on the S&P 500. It honestly need to be expected, given what we were about to see on April 2nd. I'll keep you updated on the bond side tomorrow in tomorrow's video. And I'll leave it there. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. I'll see you next time. Bye.